Hello, my friends. Our today topic is about risk structure of interest rate. We have discussed till now that we have different type of interest rates which are associated with different type of bonds. It means that we have the variety of the bonds in the market, and each bond has the specific interest rate. So we want to discuss that what is the reason of having different interest rate regarding for different bonds. So actually to discuss, to know that the relationship between different type of the interest rate, we have to know that what are the factors that are affecting the behavior of interest rate in the market. So having said that, the topic of various interest rate can be discussed in two sections. The first section, which is the topic of today, is the risk structure of interest rate. In this section, we assume that the bonds that we want to focus about are those bonds with a same maturity. So we call that the term structure of these bonds are the same. The term here means the time, means the maturity of these bonds. Why are we fixing the term or the maturity of these bonds? Because of the simple reason that if the term or the maturity of the bonds are different, definitely we expect different interest rate. Assume that we have 1-year bond and then we have 30-year bond. So which one do we expect to have the higher interest? Of course, the longer term bonds, they have higher interest. So that's why if we are assuming that different bonds, they have the different maturity, because we want to know that the effect of the time is excluded at the moment, and we want to know that what are the other factors rather than time affecting the different interest rate associated with every bond. So that's why we call it that this is the risk structure of interest rate, means that whatever factor which is about the risk associated with different bonds. For example, we know that bonds are issued by different corporations or even by treasuries or by governments. So that's why the risk associated with the bonds are different. For example, the type of the bonds that are issued normally by governments or by treasury of every country, they are the safest bonds. The safe bonds are the bonds that we call them default free bonds or default risk free. Why we call default risk means that the risk of the default of these bonds is zero. Default risk means defaulting of a bond means that the issuer of the bond is unable or unwilling to pay the payment and the maturity or the face value of the bond at the maturity. So it means that if a bond is default risk free, means that we are 100% sure that the issuer won't default on the payment. It will pay the payment on the on yearly basis, and in the maturity they will pay the face value of the bond. On the other side, we have different kind of corporations that are issuing the bonds, but they are having some risk. For example, the airlines of Northwest Airlines in 20,000, during that mid-20,000, they defaulted on many bonds. Later on, even in 2011, the American Airline, they defaulted on some other bonds. So it means that once the risk of the default is associated with kind of bonds issued by corporations, those corporations, they have to hire the higher rate of interest to motivate the investor to buy that bonds. So it means that now we are talking about a kind of interest, which is the interest associated with default risk-free bonds. Default risk-free means that there is no risk with this kind of bonds. And there are some other corporations that there is a default risk with that corporation. So it means that the interest, the gap between these two types of interest is called risk premium. Risk premium by nature is actually a kind of interest rate. So it means that the name is somehow misguiding us that it is a risk, but actually the risk premium is interest rate. So it means that the risk premium is the difference between the risk-free, default risk-free bonds and with the interest rate of the bonds that they have the risk of defaulting. So if we want to illustrate this concept of risk premium, so we can use the demand and supply of the bond, so we can draw them for two different scenarios. So in the first scenario, we assume that, for example, this market is the corporate market. And then we assume that this side, for example, is treasury bond market. Why treasury bond market and corporate market? Because we know that the treasury bonds are the safest bond, are risk-free bonds. Why? Because the government is issuing them, and in case that they have any financial problem, the government is facing any budget problem, they have two ways to finance this budget problem. What are the two ways? The first is that the government can raise the taxes. The other way is that the government can, for example, work closely with the central bank, and they request the central bank to issue some bonds, to issue some money, and then through issuing the money they can finance the bond, and that's why the default of the bonds is almost zero. So now okay, we assume that we have these two markets, and then we want to draw demand and supply of the bond that these two markets are issuing. It's making a noise, so I change them. So we know that this excess is demand, these two excess, since I want to draw demand and supply of the bond. So this one is the price of the bond, and here is the quantity of the bond. The same is price of the treasury bills, and here is the quantity of treasury bills. Then I draw, here is a demand of corporate bonds. I will show you with this C, and then it is supply of corporate bonds. Then I draw the same thing. We know that the intersection of demand and supply is showing us the price. I'll show it with PC1. And then I assume that at initial level, for example, at E1, equilibrium 1, I assume that the price of the bonds, corporate bonds, and the price of the treasury bills are the same. So that's why I draw demand and supply in a way that the price will be the same for both of them. So now here is the demand of a treasury. So here is demand 1 and supply 1, and then is supply of treasury, for example, first one. And here is equilibrium 1. Then you can see that at this situation, since the price in both market is the same, so that's why we know that in the bond market, with every price there is one associated interest rate. So that's why we know that now that the price of bonds in these two markets are the same, it means that the interest rate of the both market are the same. So it means that the interest rate of the corporate bond at the moment is exactly equal to interest rate of the treasury bond. So is PT1. Okay, what will happen that, let's say that there will be the outbreak of a news in the market that this corporate, they have defaulted on the bonds. So it means that they are unable to pay the interest. So once this news is out, so it means that this bond is facing, the people who are demanding these bonds are facing a risk. default risk. And that's why the demand for these bonds relative to the other bonds will be less. So this bond will be less desirable. Based on the theory of portfolio choice, once there is a risk of default for any bond, the demand for that bond will be decreased. So now it means that the demand of this bond, corporate bond, will shift to left. I don't know, can you distinguish between these two colors? Hopefully yes. And it's gonna be the new equilibrium point. And then we have the price, new price of the corporate bonds, which we call it P2. At P2, we know that with every associated price in the bond market, there is one associated interest rate. So that's why I call it interest rate of the corporate bond, and this is the second interest rate. This interest rate, which was the interest rate of the corporate bond, 1 was exactly equal to interest rate of the treasury bonds in situation 1. So in this situation, now that the price of the corporate bonds has decreased, so it means that this interest rate, it has increased. So it means that in this situation, we know that interest rate of the corporate bond, its second situation, is bigger than interest rate of the corporate bonds in the first situation. So it means that before the default risk, so the interest rate has been lower. Now that the outbreak, because of the outbreak of this default risk news in the market, so the interest rate has increased. So what will happen? The people that previously they were interested in the corporate bonds, so now they have lost the desire towards this kind of bonds and they like to invest in treasury bond market. Why? Because of course they know that this bond is the safest type of the bond, and the government, the probability of government on treasury defaulting of the bond is almost zero. So that will cause the demand for treasury bonds to increase. So that's why based on the theory of portfolio choice, the return of this kind of bonds will be relatively higher than the return on this market, and that's why demand for treasury bills will increase. With increase, so we know that the price of the treasury bill will be higher. Once the price of a treasury bill, treasury bonds in the market is increasing, so it means that the associated interest rate with these treasury bills will be lower, because we know that there is the inverse relationship between price and interest rate. Here in this situation, the interest rate, as we mentioned before, interest rate of the treasury in situation 1 has been equal to interest rate of the corporate bonds in situation 1. But now what is happening here? That the interest rate is decreasing. Can you see the difference between interest rates now? So we started from this point that the interest rate of both markets, both bonds, they have been the same, and see that what is happening now. The situation here that the interest rate here is very low at this situation, and the other interest rate is here, which is very high. So if we consider this difference here, so the difference between IT2 interest rate with IC2 interest rate, this gap is called risk premium. As you can see, this graph is showing risk premium has the nature of interest rate. So it means that risk premium is the difference between the interest rate of the higher return bonds because of the risk with the interest rate of the risk-free bonds. This is the concept of risk premium. So now to conclude this session, we can say that one of the factors affecting the different risks, different interest rate on different bonds, once we assume that the term or the maturity of the bonds are the same, is default risk. And in the default risk topic, we introduced the concept of the risk premium. To continue further, we can say that the second factor which is affecting to have different interest rates related to different bonds is called liquidity. So I put here the second factor is liquidity. Liquidity concept, it means that how fast you are able to sell your bonds. It means that how much immediate demand is available in the market for your bonds. For example, if you are holding a treasury bond, since treasury bonds is very famous and is very well known, so if you want to cash your bond, you want to sell your bonds, you can easily find a demander or a purchaser in the market. However, for the corporate bonds, since it happens that sometimes they are not very safe and they have this default risk with them, so that's why normally it happens that you need more time. So in other way, we can say that treasury bonds are more liquid than the corporate bonds. So once we are talking about the liquidity, automatically we know that liquidity is linking us to the concept of demand for the bonds. So it means that if again we want to start from the equal situation like we started before, and we assume that the price and therefore the interest rate of both markets are the same, we can discuss about the liquidity of the market. So we can say that once there is a news of default in the market, so the liquidity of one market will be affected. So since this bond will be less liquid, so this bond will be less desirable in the market and the demand will shift to left. With shift of the demand, the price of the bond will be less and therefore the interest rate will increase. And this other way around, exactly other scenario is happening here, that once again the liquidity of one market will be less, so the people are more interested to have the bonds of the other market. So it means that the treasury bonds will be more liquid. Now that they are liquid, it means that the demand will shift towards right, and again we're going to have the higher price. Higher price is associated with lower interest rate. And again, the gap between different type of interest rate that we were discussing is appearing. So again, we can say that any factor which is causing the difference between two type of bonds, the difference between interest rate of two type of bonds, if this difference between interest rate is associated with default risk or associated with liquidity, this gap is called risk premium. So it means that the concept of risk premium sometimes is called risk liquidity premium. So it means that both they have the same meaning, risk premium or risk liquidity premium. So it means that it's a kind of difference which is derived because of the difference in risk and difference in liquidity. But of course, in most of the books, they summarize, they prefer the abbreviated format, so that's why instead of risk liquidity premium, they use the risk premium. So I hope that it is clear.